All right, so this will be our final class. And in this class, we're going to be talking about contingent interest. So again, what I want to do is start with the whiteboard and show you why we have this problem with contingent interest. How should we be taxing these debt instruments? And the problem, it created a problem for the Treasury for quite a while before they finally came up with the rules. And let's go over and show you why they had all these problems and trying to come up with the rules to tax these things, and then they finally came up with a compromise. So contingent interest is someone will issue a debt instrument, and then the amount that they pay back has nothing to do with the cost of money. The interest rate that they're paying isn't really an interest rate. So we'll have contingent interest. And we'll issue debt for $10,000. So that's the original issue. And then what they'll say is, in 5 years, they will repay minimum of $10,000. So you're guaranteed to get your money back. And the maximum will be the $10,000 for the value of what $10,000 invested in the S&P 500 is 5 years from now. But no more than let's call it $17,500. All right, and I'm just making that number up. And so you look at this and you go, what is this? That's not really interest. Interest is based on the cost of capital, based on the cost of money. The value of the S&P 500 5 years from now is not, it has nothing to do with interest rates. So what is this instrument? And if this is issued by a bank and you ask the bank, when they take in the $10,000, what do they do with it to make sure that they're going to be able to make these payments? And what they're probably doing is they're probably buying a 5-year zero coupon treasury. And if interest rates are roughly 2%, they're spending $9,000 for that. Because in 5 years at 2%, that'll grow by 10%. And with compounding, that'll get them close to the $10,000. It might even be a little less than $9,000. So the $9,000 is they spend on that. And then we're going to go back to the first day of class. And what they're going to do is they're going to buy a call on the S&P 500 with a strike price $10,000. And they're simultaneously selling the call on the S&P 500 with a strike price of 17,500. When you combine those instruments together, that's going to be the payout on this debt. The $9,000 zero coupon treasury will grow to be $10,000 5 years from now. These calls are 5-year calls. I didn't say that, but these calls are going to be 5-year calls. And so if the S&P is worth 10,300 5 years from now, the call that has a strike price of $10,000 will have a value of $300. So you combine the value of the call, $300, with the zero coupon, and that's how the bank will pay back $10,300. If the S&P is up to 10,750, this call will be worth $750. They'll take that, add it to the $10,000 of the treasury, and they'll be able to pay off the debt. And then if it goes to 11,000, this call will be worth 1,000. This call will be worth minus 250 because you've sold it. So again, the two combined are going to equal 750. Add that to the treasury, and you'll always be able to pay off the amount. If it goes up to 17,500 rather, this call is going to be worth $7,500. This will be worth 0. You'll take the 7,500 plus the 10 is 10,000, is 17,500. If the S&P goes up to 20,000, this one will be worth 10,000. This will be worth a minus 2,500. Combined, they'll be worth 7,500. Add that to the 10,000, and they'll be able to pay off $17,500. Like with the way these numbers work, this 17,500 is probably overstated, but that's neither here nor there. So what Treasury had to look at was, how are we going to tax this thing? Because what this really is a combination of 2 or more instruments. So should we break it out and say this is really part OID and part option spread, and that you have ordinary income on the part that's the OID instrument, and the other part should give rise to capital gain or loss? And the Treasury did think of doing that. But eventually they changed their mind. And the rule that they eventually came up with is that this is either going to be treated all as a bond, or all as an open transaction. And if it's an open transaction, everything gives rise to capital gain or loss. If it's a bond, everything gives rise to interest income. And you could end up with some capital loss, but that's rare. And that's the way the rules ended up coming into play. So what I want to do now is go back to the PowerPoint and go through all the rules, and then we'll come back to the whiteboard and work through some examples. This was the basic dilemma, is that when you look at one of these debt instruments, it's really a combination of a debt instrument combined with derivatives that are inbred in it. And the question was, how do we tax that? Do we break them apart, or do we tax it as one instrument? And as I said, the Treasury decided, no, we're going to tax this as one instrument. So let me stop sharing and let me go back to the PowerPoint. And let's go through the law. Okay, here's the PowerPoint. So the first thing is, as I said, when we have contingent interest, the amount it really fluctuates. And it's tied to the performance of some other asset or index. So in the example I just gave you, it was tied to the S&P 500. It could be tied to anything. It could be tied to the price of gold, price of silver, um, oil, anything. It could be a different financial index. It could be based off of the NASDAQ 100. It could be anything that you want it to be. But it just has no real interest. It has no real bearing to interest rates. But it's in the form of a debt instrument, so we have to treat it. We're going to end up treating this contingent interest as interest. And we just have to figure out how do we do it. So where are these rules? The rules are in the regulations. And the regulations are under 1275-4. It's 1.1275-4. They make two key assumptions in order to come up with an answer. And both assumptions are wrong. That's interesting. So the first assumption is that the interest amounts that we're going to accrue are actually going to be paid. And we'll see that that's not what happens. And we also assume that the debt's yield can be determined on the date of issuance, and we know that can't happen. We have no idea what the underlying asset's going to do over the next few years. But in order to make the rules work, we make believe that we can do both of those things. Remember, this really has to be contingent interest. It's not that the interest is variable because rates are changing. So in some debt instruments, you start with a fixed, you have a fixed principal amount, you have varying rates of interest. You have it based on commercial paper rates, and commercial paper changes every 90 days. It's a 5-year instrument. The underlying rate is going to change every 90 days, but that's not contingent interest. We know what it's based off of. It's based off of an interest rate. That's all treated under the regular OID rules, and they're treated under the regulations of 1.1275-5. Or we can have it where the interest rates may vary based on an index that people use to measure interest rates by. Could do it based off of LIBOR, based off of Fed funds. That's not a contingent debt. That's just the debt that has its rates varying, but they're all based on interest type rates. And as I said, those are under Reg Section 1.1275-5. So now the question is, when we look at contingent debt and what the Treasury wants to focus on is it really debt? And if it's not really debt, then we're going to treat it as an open transaction, and we're going to treat everything as capital. If it's really debt, then we're going to treat it as a debt instrument, and everything, all your income is going to end up being interest income. So again, remember, there's typically no coupon. There's typically just one payment at the end, and it's tied to the movement of some property. And as I said before, when we first started, this really is a combination of a zero coupon bond along with some sort of derivative. And the way you can tell that is you ask the person who issued the debt, what are you doing to hedge yourself? What are you doing to make sure that you're going to be able to pay off the debt at the end? And they'll tell you, oh, I'm buying a zero coupon bond of a certain amount, and we're entering into this derivative of Y amount. And when you add up the cost of the zero coupon bond along with the derivative, you're going to find that that's less than the amount of money the investor has given to them on day one, and that's how they make their money. So in my example, they spent $9,000 on that bond. They would have spent $900 on the combination of those two call options. They would have taken in $10,000 from the investor. They spent $9,900. There you go. They just made $100. And if we start adding zeros to that, it starts to get exciting. Okay, so what are the tax rules? The tax rules are, we understand that economically, this one instrument is really made up of two or more instruments. However, for tax purposes, we're not going to try to bifurcate it. I might come up with one sort of derivative as my hedge. Another investment banker might use a different type of derivative as their hedge. We're not going to try to figure out what everyone's using to hedge their exposure. So what we've decided is that we're either going to treat this whole thing as debt, or we're going to treat this whole thing not as debt. So how do we know whether we should treat it as debt? We say, look at the terms. And if under the terms, substantially all the amount that the debt was originally issued for is guaranteed to be paid back, then it's debt. And these things are referred to as principal protected notes. So my example, I said the investor gives us $10,000, and at the end of year 5, they're guaranteed to get back $10,000 plus a rate of return on the S&P 500. The fact that they were guaranteed to get back their $10,000 means that this is debt. They can't lose their original investment. And so in that case, we're going to treat it as debt. However, if there's a reasonable likelihood that substantially all the amount that the debt was issued for can't be recovered, then it's not going to be treated as debt. So I think on the next slide, yes, I have some examples. So in the first one, again, the investor pays $1,000 for the instrument. The instrument is going to pay back the investor $1,000 plus 90% of the move in the S&P 500 3 years from now. So if the S&P goes up 50%, the investor is going to get 45%. If the S&P 500 declines, they tell the investor, don't worry about it. You're still going to get back your $1,000. Because the investor is always going to get back $1,000, the instrument is now going to be treated as debt. Now, the issuer might be some bank. If the bank goes bankrupt, the investor is not going to get their money back, but that happens with regular debt as well. So that has nothing to do with the debt being contingent debt. We just look at the terms of the note. And if under the terms of the note, the investor is going to get back all their money regardless of the movement in the underlying asset, then that's going to make it treated as debt. Now we have an instrument where the investor again pays $1,000 for the instrument. And the investor is going to get the upside in the S&P 500 over the next 3 years, but it's capped at 1,500. So it doesn't matter how high the S&P goes up. The most the investor is going to get back is 50% more than they put in. The investor will receive $1,000 at maturity if the S&P 500 is at least equal to 98% of what it was on the day we entered into the transaction. So if the S&P goes down by 1 or 2%, the investor is still going to get back their $1,000. However, if the S&P is below 98%, to the extent it's below 98%, the investor suffers a loss dollar for dollar. Well, if the S&P were to lose half its value, the investor would lose 48% of what they gave, and they'd only be able to get back $520. There's a reasonable likelihood that they may not get back substantially all of their money, because if the S&P goes down 10%, which isn't so far-fetched, they're only going to get back 92%. This instrument is most likely not going to be treated as debt. I mean, I don't have a specific rule that tells you how far does it have to be that there's a reasonable likelihood that you're not going to get back all your money. But I think this one, I'm pretty sure has it. Right? So this instrument is probably not debt. If I put a question on the final exam, you'll know whether it's debt or not debt. I'm not going to make it a close call. Okay, so if it's not debt, how is the transaction treated? It's treated very simply. It's treated as an open transaction. We wait until maturity. We compare the amount that you get back at maturity with the amount that you put in on day one. And whatever the difference is either capital gain or capital loss. So when it's not debt, it's simple. It's when it's treated as debt that now we have to do some computations. So if it's treated as debt, there's a 4-step method that we have to go by. The first one is we have to find out what interest rate would the issuer have paid you if this was non-contingent debt. If they just issued a straight debt instrument, how much interest would they have paid you? And so we're going to come up with that number. Then based on that interest rate, we're going to come up with a projected payment schedule. Then we're going to see what the daily interest portion is. And then finally, when you get the final payments, we're going to see the difference between the actual and the projected payments, and we're going to account for all of those things. So again, when I do words like this, I get it that no one's following. And I'm just going to go through the next 4 slides, and then we're going to go to an example. So what's the comparable yield? We just ask the issuer, if this is a 5-year instrument, how much what interest rate would you have paid on a 5-year instrument? And that's the interest rate we're going to use. We're then going to take the 5% interest and we're going to compound it on a semi-annual basis, and we're going to come out with a projected payment schedule. We're going to apply the OID rules with respect to the projected payment schedule to determine the daily interest portion, and the investor is going to accrue that income as though it were an OID instrument. And then finally, we're going to say, okay, let's true it up. What were the payments, and let's compare them to what the projected payment was going to be. And whatever the difference is, then we'll fix everything up at that point. So let me go to the whiteboard, and let's just go through those steps. So let me get rid of this. And we'll go to an issuer. An issuer is going to issue debt of $10,000. And it's going to be paid off in 5 years. And they're going to pay a minimum of $10,000. But you know what? Let's do the easy one first. There is no minimum. They're going to pay the value of the S&P 5 years from now. Capped at 20,000. We'll let you double your money. For the first 2% downward move, the investor suffers no loss. But then after that, the investor loses dollar for dollar. So because there's a good chance, or there's a reasonable chance, there's a reasonable likelihood that the investor is not going to get back substantially all of their $10,000, this is not debt. If this is not debt, we wait until the end. To recognize any income or loss. And everything is either capital gain or capital loss. All right, so if we receive $17,000 in 5 years from now, we have a $7,000 long-term capital gain. If we receive $9,000 5 years from now, we have a $1,000 capital loss. Right, so this one is simple, or right? This one's easy. Now we have the same thing. The issuer issues debt of $10,000. Let me see if I can copy this. Okay. Issuer issues debt of $10,000. Paid off in 5 years again. It's going to be the value of the S&P 500. Cap at 20,000. By the way, that cap is really high, so it probably wouldn't be that in real life. But the minimum you're going to get, you're always going to get back your $10,000. I'm going to change that, and I'm going to say if the S&P goes down by 2%, you suffer the first 2% loss, but that's it. You don't lose anything more than that. So the minimum is 9,800. So there's a reasonable likelihood you're getting all your money, almost all your money back, substantially all of your money back. So this is going to be treated as debt. So now, because this is going to be treated as debt, step one, what interest rate would the issuer have paid if this was just normal debt? And again, just to make the numbers slightly easier to use, let's assume it's 5%. Now we have to come up with a projected payment amount. There's only going to be one payment. So what we would do is we would take 5% and compound that semi-annually. So if I take 5% for 5 years on $10,000, that would come out to $2,500. If I compound it, it'll probably come out closer to $3,000. We're going to compound it semi-annually, and the fact that it's compounding, so that our expected value at the end would be about $13,000. And then we would apply the OID rules to this. And because we're going to apply the OID rules, for the first 6 months anyway, we would take $10,000 and multiply that by 2.5%, because remember on OID we compound semi-annually, and the 5% is an annual rate. So times 0.025. And for the first 6 months, we would have $250 of income. And we would have to accrue that income. We would pick that up. And we would do that for the 5 years. So every 6 months, we're going to be picking up income, and we're not receiving anything. And we have no, and it doesn't matter what the S&P is doing. The S&P can be down 30%, and we're still picking up income. That's just the way it goes. And then the fourth thing we're going to do is we're going to then compare the actual payment with the projected payment. Now, by the time we get to the very end, we will have accrued the entire difference between the 10,000 and the final projected payment. So if the projected payment, I'm going to go to the top here, and hopefully I won't run out of room. So let's put the projected payment was $13,000. Well, if the projected payment was $13,000 and it's the day before the projected payment, we've accrued $3,000 of ordinary income under the OID rules. And now we're going to say, okay, what's the actual payment going to be? Because what is the S&P now? If the actual payment is greater than the 13,000, so if actual payment is greater than projected amount, then we have additional income. And we pick it all up at maturity. We don't redo the prior years. We have additional income at maturity. And it is all interest income. Which is weird, because the reason that we're getting these large amounts is because of the movement of the S&P 500, which you would think should give rise to capital gain, but it doesn't. It's all interest income. Now, the next question is, so now the next thing that can happen is we still get an amount greater than 10,000, but less than 13,000. So if actual is in between original amount and projected amount, the difference between the projected amount and actual amount can be taken as an ordinary deduction. Right? And that makes some sense. So if we receive $12,000, we've already accrued $3,000 over the life of the instrument as ordinary income. So they say, okay, you got 12,000, you were projected to get 13,000, you're $1,000 shortfall. That $1,000 shortfall, we're going to let you take as an ordinary deduction. And the reason we're letting you do that is because you picked up the $3,000 as ordinary income. So we're going to let you offset it as an ordinary deduction. We're not going to give you a mismatch between ordinary and capital. If the actual is lower than, if actual is less than original, then deduct full amount that was accrued and excess loss is capital. So if we receive $9,800, and I'm going to do it on this line because otherwise I'm going to run out of room. If we receive $9,800, we're going to have a $3,000 ordinary loss. And then we're going to end up with a $200 capital loss. So to the extent that we picked up $3,000 of ordinary income and we're not getting any of that, they're going to let us take an ordinary loss. That gets us back to the 10,000. But once we put in 10,000, we're only getting back 9,800. That additional 200, they're saying, hey, that's a capital loss. And that's the way you're going to treat it. So at the end of the day, it's not super, super complicated. It took Treasury a long time to get to this answer. But if we end up with the debt being treated as too contingent, we don't know what you're going to get. You might not get all your money back. We're going to treat it as an open transaction. And if it's an open transaction, we just wait until the end. And then we compare, what did you receive? What did you pay in? Whatever the difference is, that's capital. If it's a gain, it's a capital gain. If it's a loss, it's a capital loss. and you've deferred everything until the end of the transaction. If it's debt, we're going to treat it as an OID debt, original issue discount debt. We're going to ask the issuer what interest rate would you have paid if this was not a contingent debt, and that's the rate we're going to use to accrue our income. And then when we get to the final payment date, we'll have accrued all that income. Our basis is going to include all of that amount. And then we're going to compare that with the amount that we receive. If we get more than that, we're going to pick up more income at that time, but it's all going to be ordinary income. But at least that excess is all deferred until it's paid. If we get something in between our original investment and the projected amount, we get an ordinary deduction for the shortfall, and that's it. And then we end up with a semi-fair amount, the fair result. Remember, we've accrued all that income in the early years, and now we're getting a deduction in the later years, but at least we don't have a mismatch between ordinary and capital. And then finally, if the amount that we receive is less than the amount we originally gave, we get to deduct everything we've accrued over the life of the note, and then we take the additional shortfall as a capital loss. Right? So that's the way the rules work with respect to contingent debt. So let me go back to the PowerPoint. And I think the only thing that's left in the PowerPoint are other examples. And so it's the same thing that we just did. So we have the bonds with a single payment at the end. Over the life of the bond, the owner has been accruing income, which is what we just saw, the $3,000. If the final payment is greater than the projected amount, the excess is treated as additional interest income. So if it was $13,000, we get $17,000, we've got an additional $4,000 of income. And if the final payment is less than the projected amount, to the extent that income has been accrued, the shortfall may be taken as an ordinary deduction. So that was my example of, I'm forgetting the numbers. So let me just go back to the numbers very quickly. Sorry. Okay, yeah, so we're going to have $13,000. We got $12,000, so our shortfall was $1,000. We end up with the $1,000 ordinary deduction. And when we get $9,800, we get to reverse the entire $3,000 that we picked up in the early years, and then we get the additional $200 as a capital loss. So eventually the economics and the taxes all equal out. All right, so this was again, another example. Assumed debt is issued for $1,000, projected amount to receive at maturity is $1,500. All $500 has been accrued. Now we get the final payment. If the final payment is $1,800, then additional $300 is interest income. If $1,300 is received, the $200 shortfall is an ordinary deduction. And if $980 is received, the entire $500 is an ordinary deduction, and the remaining $20 is a capital loss. All right, so that wraps up contingent interest. That wraps up the course. And I hope you all enjoyed the course. I think this is your last course in the program. So hopefully you also enjoyed the program. And you're all getting your degrees, and this is it. So the last thing for you to do now is take the final exam. Again, it's going to be just like the midterm. It's going to have a lot of problems. And I wish you all the best of luck. So take care, everybody.